Hello, everyone. My name is Aravind Suresh. Thank you very much for attending this event. Today, I'll want to talk a little bit about my journey, my personal journey coming from university into private equity, and then now what I've done since. I'll be talking to you about what private equity is all about, what you can be expected to do on a day-to-day basis. And for those of you who didn't know, or who don't know rather, I worked in private equity as an associate, but I left last year. And so I am now free to tell you both the pros and cons in a way that I don't think any other representative who's still working within the PE or finance field can do. So I think this should be a great opportunity for you guys to ask the questions that you probably fear asking other people if you've ever networked. And I will try and give you as much of an honest and straightforward answer as possible. I think one of the more unique things about me is firstly that I didn't get any spring weeks in my first year, and so really had to work my way back from that deficit in my second year. And also that I managed to break into private equity straight out of university, which is relatively uncommon, but I will explain how exactly I did it over the course of this talk. Spoiler alert, it's nothing exciting. And then whilst I was at university and whilst I was also working at full time, I also launched ASURE UK, which is an education and early careers consultancy. Basically, I launched it with the idea that I didn't get into spring weeks, and actually it was because I didn't know some very basic things that, had I known, I think would have made my application process so much more easy and streamlined. And so I didn't want any talented students to miss out on opportunities that they deserved and dreamt of simply because they didn't have the right information at the right time. So at the end of this talk, if you found it useful, we'd really appreciate if you liked and subscribed and stuff. And then I'm also trying to fully grow this out and expand into other areas, provide more resources and things for people to benefit from. Let me talk about private equity in terms of the actual structure of it. And the way I describe private equity to a lot of beginners is that it's kind of like buying a rundown house, in the sense that you've probably heard of people who will buy old houses that need a lot of work. They'll buy it with sometimes a mix of their own cash and like a bank loan or something. They'll then go and refurbish the house, make it all nice and pretty and livable, and then they'll rent it out on the market for, let's say, a few years, maybe 5 years or so. That rent they'll take in as their income. And at the end of the 5 years, hopefully the value of the property that they initially bought has appreciated. Some of that will just be because of all the refurbishment work that they did initially, but also it will just be due to changing markets and things as well. And at the end of those 5 years, they'll look to sell it at a higher price than what they initially bought it for. And that is, if you replace the word house with the word company, at its core, that is effectively what private equity also does as well. So you, in a lot of senses, buy companies where there is a lot of room for improvement. Over the 5-year period, you'll go and improve the company, and any profits that the company generates, you will go and take that and distribute it. And then at the end of the 5 years or whatever, you'll then go and look to sell the company for more money than you bought it for. In terms of how the industry actually works, so behind a private equity company, you've got two sets of, I guess, characters, let's say, right? The first are what you call limited partners. Limited partners are effectively companies or legal individuals that will provide money for the private equity to then go and invest into assets. So those could be things like insurance companies, pension companies, sovereign wealth funds, and also in some cases, and increasingly, high net worth individuals as well. So they provide all the capital, but they don't have any say on how the private equity firm itself invests their money. That is the responsibility of the private equity fund manager, who is known as the GP or the general partner. The job of the general partner is to take that money from the limited partners. That money from all the limited partners gets pooled into a fund. And then that fund is then, the cash that is in that fund is then deployed into purchasing several assets that form a portfolio. Most assets tend to go through a very similar investment life cycle. So the first thing that you do is you would buy the asset. And when you buy it, actually, before buying it, you will come in there with a certain investment thesis. So what do you think it is about this specific company that makes it attractive? Is it because it's in an industry that is set to grow, or is it that the company itself has some sort of proprietary technology that makes it super unique or poised to benefit in the future? Is the geography that it operates in really good? Are there high barriers to entry? All those sorts of things. Basically, rationale as to why you're choosing that company over any other company, and why you're choosing that industry over any other industry as well. Then once you've bought the company, or once you've hopefully bought the company, it's then your mission to go and execute on that investment thesis. So you would have come in to the company saying, okay, I'm going to do these 5 things to turn the company around and double its profitability and things like that. During the hold period or the improvement period, it's your job to just go work really closely with the management teams of those companies to go and actually grow the company and execute on that plan. Then finally, it's the sell. So after the 5 years, obviously the limited partners, the people who've originally invested into your fund, will eventually want their money back. As much as you're growing their return, if they've invested $1 billion into you, at some point they will want their $1 billion plus change back. So at that point, it's your job to sell the asset or the investment that you've made. And when you do that, you spend a lot of time working with the company to pitch a narrative. Basically explain to other potential buyers why that company is a good buy for them. And you'll do a lot of work with investment banks and consultants to really fine-tune that story. And hopefully you'll sell the asset for more than you bought it for and return that capital back to your original investors. I said earlier that the GP normally is solely responsible for the direction of the fund. I should also note that they, in a lot of cases, also do provide a little bit of cash. And that's the reason why they do that, is to just align incentives. Because if their money wasn't on the line, then they might act irresponsibly. So to ensure that everyone, both the LP and the GP's incentives are aligned, the GP will throw in some cash of their own as well to make sure that they are acting responsibly. So then it comes to, how do private equity funds themselves make money? Has anyone heard of the 2 and 20 model before? Yeah, so the 2 and 20 model is the baseline way in which private equity firms have historically made money. So the 2 refers to management fees. So what that is that the private equity fund will charge 2% of the capital that they have raised from the limited partners, the LPs, just for managing their money. So whether the investments do well or not, that 2% is kind of fixed. And that isn't really meant to be a massive profit maker for the private equity fund. In reality, that 2% is just meant to fund the day-to-day expenses of the firm, like the rent of the office, the rent of the cost of hiring employees. Sometimes it's the due diligence costs of identifying what investments to make and finding out whether they're good investments. All of that requires upfront cost, and that's what the management fees tend to cover. And then you've got the performance fees, and that's the really big ticket item. So what performance fees do is, when you set up a fund and you go and pitch it and advertise it to your limited partners, they will say that we're going to try and target you a certain return. Let's say it's 8% or 10%. And then what the private equity fund will do is, up to that 8%, it all goes to the limited partner. But above that 8% or 10%, which is known as a hurdle rate, anything achieved above that, normally 20% of those excess returns will go to the private equity fund manager. So let's say, for example, that the hurdle rate was 10% and the private equity firm actually delivers 15%. Then the difference between that 15 and 10% is 5%, and then 20% of the 5% is 1%. So they would capture 1%, that 1% sliver, as performance fees. So they won't take anything below the 10%, because that's in effect like what is guaranteed or promised to the original investors. But above that, they want to say, hey, look, we've done so well with our investments that we feel that we deserve a cut of that additional excess profit. And that's what that 20% is. I want to try and do a very simple, I say simple, simple-ish example of performance fee calculation using catch-up. So let's say in December 2020, the private equity fund has invested $100 million, and it's a very short-term private equity fund, for example's sake. They sell all of their assets the next year for $115 million. So Since it's only 1 year, that is a 1-year annualized return of 15%. And these are the terms. So first of all, you have to return the principal to the original investors. So you have to return as much of the 100 million that you originally took from them as possible. Then you are giving them an 8% cumulative return, which is the hurdle rate here, to the limited partners. So on 100 million, that is that 108 million here that you're promising them. That 8% is protected. So if the private equity fund delivers 7%, that entirety of that 7% is going to the LP. If they deliver 8%, that entirety is going to the LP. It's only at the point with which the 8% hurdle rate is exceeded does the private equity firm ever see like a penny in performance fees. And then you're saying that there is a full catch-up for the general partner equal to 20% of all distributions in steps 2 and 3. So the way catch-up works is if the private equity fund has only outperformed the 8% by a very small amount, if they were to then do a 20-80 pro rata split, their performance fee would be really, really small. So to compensate for that, some private equity funds have a concept called catch-up. Everything goes to the GP, so goes to the private equity firm until the point at which they've got to their 20% performance fee, which means that once the 8% hurdle rate has been delivered, that 8% for the LPs becomes 80% of the total returns that have been split. The limited partners have been given 8 million, and we want 8 million to be 80% of the total amount. 8 million being 80% means that the general partner is owed 2 million. And then so you've given 8 million, the general partner has now caught up their full 20% to 2 million, and that leaves you with 5 million excess. And then the 5 million, as I mentioned before, is now going to be split pro rata 20-80 between the GP and the LP. So that actually means that the general partner is going to be left with 3 million, and then the limited partner is going to make a total of 112 million. So we're basically saying, okay, we've got 108 million, and then we've made 115 million total. The next 2 million, all of it goes to the GP. And then, okay, you've now got 108 plus 2, so we've now distributed 110. We've now got 5 million remaining. And of that 5 million that we've got above that 110 million threshold, now that's going to be split 20-80 GP LP. If you look at the actual people who are entitled to the performance fee, it's actually a very small proportion because the majority of employees are being paid out of the management fee. So it's only a very small select people who get given this opportunity, which is known as carried interest. Firstly, it depends on the fund strategy. So we'll get onto this in literally a second, but different funds will invest in different areas. So my fund, for example, invested into infrastructure. And infrastructure, because of certain characteristics I'll go through in just a second, tends to generate slightly lower returns because it's seen as a more stable investment. Whereas if you invest into like an AI startup, right, as a private equity fund, your upside could be huge. Like you could 10x your money, but you can also go bust, right? So accordingly, so private equity firms typically I would say go for above 20% returns, 20% plus. But their hurdle rate will be lower. The hurdle for an infrastructure fund, for example, might be 8 or 10%, but our fund target returns were 13 to 15% to give us that leeway. So, as I mentioned, I worked in a specific subsector of private equity called infrastructure private equity. Some people debate whether infrastructure private equity is actually private equity or not, but for all intents and purposes, I would argue that it is. So, what is infrastructure private equity? It is pretty much a subsector of private equity where you're investing into infrastructure assets. So by that, I mean assets that you and I have to use on a day-to-day basis that are needed to support the day-to-day functioning of our normal society. So just to give some examples of how you might be able to segment infrastructure, it could be utilities, so energy, water, electricity companies. It could be mobility. So that could be things like airports, toll roads, railways, ports, things like that. There's digital, which was the sector that I particularly focused on whilst I was working. And so I was involved in things like buying broadcast towers, data centers, fiber optic networks, mobile towers, anything that you and I basically use to get connected to the internet or similar telecoms-esque services. And then more recently, people are expanding into kind of new sectors of infrastructure, about things that people historically might not have actually even considered as infrastructure, such as social and diverse. So those are things like healthcare facilities, like private education, car parking, databases, things like that. So normally why people invest in infrastructure is for these three reasons here. The first being that it's inelastic. The demand for infrastructure services is relatively inelastic, because whether we're in an economic downturn or we're in an economic boom, the demand for your water or your electricity or broadly the number of people who want to take flights a year isn't really going to be all that volatile relative to, let's say, again, like an AI startup where no one knows what the demand could be. No one knows if you're going to get overshadowed the next year or anything like that. And that takes me on to point two. So in most instances, infrastructure is what we'd call a natural monopoly. And by that, I mean it doesn't normally make sense to operate two of the same exact service within the same geographic area. There's no point realistically of someone deciding, hey, you know what, I'm going to replicate the entirety of the tube. Because since the tube exists and it's already completely fine, the amount of capex, like the amount of investment that would be required to replicate the tube for no real additional value, basically means that it's not worthwhile. So because of that, it's really, really difficult for a new contender to really enter an existing, well-established infrastructure space. And because of one and two, it means that in a lot of cases, the contracts that you get with infrastructure companies are really, really long-term. We're talking 20, 30, 50-year contracts, which means that you don't really have to worry about, hey, am I going to lose a major contract next year? You know that for the period with which you've invested into that asset, you know that you're, in most cases, going to be absolutely fine from a customer risk perspective. And additionally, a lot of the contracts have inflation clauses built into them. So if you turn your minds back to, I don't know, 3-4 years ago where we had super high inflation, and we're probably going to get into a similar period now, right? The effect of that is that it obviously reduces the value of money, which means that for someone who's investing 100 million, if 10% of their 100 million is lost due to inflation, that doesn't actually mean that can actually impact the real return that you're delivering for them. So a benefit of infrastructure is that in a lot of cases, the contracts will quite clearly say, hey, every year the pricing of this service is going to increase by CPI plus or minus a certain amount, which means that in a period of high inflation, you're kind of protected. Your downside is very much hedged because you know that you're going to be able to pass that on to your long-run customers. So that's why a lot of people, a lot of investors find infrastructure quite attractive. Okay, so let's talk about getting into private equity now. The most common route into private equity is normally to do 2 to 3 years of investment banking. And the reason why is investment banking is kind of seen as the perfect training ground to build the skills that you'll then use on a day-to-day basis for private equity. If you work at an investment bank as an investment banker, you'll be exposed to multiple deals at the same time. And so you'll get to see different sorts of transactions, different sorts of strategies, and how they're being employed in different sorts of industries as well. So it'll give you a really strong breadth of knowledge and exposure. The other thing is that I'd say that investment banking more generally seems to have a better culture of mentorship because the deal teams tend to be a lot larger when you're doing client advisory work. If you're an analyst, you'll have an associate who then has a VP, who has a senior VP. And so at every stage, you're being mentored by someone quite literally the stage above you. And they're constantly assessing your work and giving you advice on where you can improve if you've got a good associate or a VP, let's say. Whereas in private equity, as I mentioned before, the deal teams run a lot smaller. So when I was on a deal, for the first parts of a deal, it was me, a senior VP, and a director. And so you can't really expect a senior VP to be spending hours looking through a model with you because that's not their job and they've got a million other responsibilities. And so it's you're very much left to your own devices to go and run financial analysis and figure out how to model something. And so that's actually something that I really struggled with. Whereas if you go into investment banking, is kind of your job to get good at modeling as an analyst and an associate. That's kind of what you're paid for. And I guess it also speaks to what investment banking is actually for. So when you're working on a deal as a private equity analyst or an associate, your job is to think about the investment thesis, the strategy behind like why something is a good deal. But actually, once you get into the weeds of a deal, you, in a lot of cases, pawn off the nitty-gritty financial modeling itself to the investment banks to run overnight. So you'll spend ages doing maybe the first high-level model and thinking about, okay, we need to improve the model and think about all of these different scenarios. But in terms of actually executing on those scenarios, it will be the investment bankers who are working until 2 or 3 a.m. actually doing those scenario analysis. So that's why investment banking is the most common route. And these are just kind of some of the difficulties that I found having come into private equity directly out of university. And that kind of takes me on there. It's normally very, very rare to go straight into private equity from university for all the reasons that I mentioned about why investment banking is so good. Private equity in and of itself, I wouldn't say is a great place for you to learn the technical parts of either a deal and the technical skills like financial modeling and things like that. You're far better off being in investment banking for that, in my opinion. I will say though that obviously private equity in and of itself forces you to focus on different parts, and you will build different skills. For example, you will develop that strategic thinking, that critical thinking side of things, analyzing whether it teaches you to be a good investor from a sense of, is this a good deal? What things could go wrong? And it also forces you to be a really good communicator, because you need to be able to effectively communicate with the investment bankers and the consultants who are assisting you on the deal, but also with the management of the companies that you are buying as well. So those are all good skills that you will develop if you were to work in private equity. It's a lot more common to break into private equity from university if you target a more niche area of private equity, such as real estate or infrastructure in my example. The more common kind of let's talk like software, the Apollos, the Blackstones, their core private equity strategy normally tends to be reserved a lot more for investment bankers, unless you are truly, truly exceptional. And then finally, some people break into private equity with still full-time experience, but it won't be in investment banking. The vast majority of people come from investment banking, but you do also see people break in from strategy consulting, I guess because they've got the strategic thinking, critical investment thesis development sort of skills. And you also see people sometimes break in through Big Four, particularly things like their transaction and valuation services. And then also some people do having previously worked in industry, make the pivot over. Investment banking is still by far the easiest pathway, because it's a lot easier to teach the strategic thinking side of things than it is to teach the technical modeling side of things, I would personally say. The only thing that I found people from investment banking struggle to struggle in private equity at a more senior level is that because they come from investment banking, they want to pitch everything as a good deal, because that's kind of what they're taught to do as an investment banker, rather than actually assessing whether a deal is actually good for the private equity firm or not. I will say that some firms split their private equity investors into an investment team and an asset management team. And I think a lot of the investment bankers go into both teams, and the strategy consultants tend to skew more towards asset management, because that's where the value creation piece really tends to go. But I do agree, generally, it's a lot more rare for strategy consultants to still break in. I will be open about that. And yeah, I think you've got to be lucky that the fund that you are recruiting for has that sort of operation or strategic development type role, because as a strategy consultant, you are not building the financial models that the investment bankers are so used to doing. You are using Excel, but you're using that for market mapping or market sizing type roles, functionality, as opposed to an investment analysis, returns analysis type thing. I think it's much more common in venture capital than it is in private equity, because again, think about it from a private equity fund's point of view, what do they care about is, does this individual have the technical modeling skills? Above anything else, is that's like the main thing that they're recruiting for, which is also why even at an internship level, I was speaking to someone who was applying for an internship at KKR. They will give you an LBO test to run because that is your bread and butter. And let me give like a good example of something that my director said to me, because I initially really struggled with financial modeling. It's all well and good having an investment thesis or like a strategic view on whether something is a good company or not. But unless you have a financial model to have the numbers to back up your view, it's the analogy he said was, it's kind of like driving in pitch dark with no headlights. Like you might have no matter how good of a driver you might be, you kind of need that financial model to assist you in your judgment. And so VC is a little bit different. So venture capital is technically a subset of private equity, technically, where you're investing into very small early stage companies. And there, the early stage, like the founder experience is a lot more seen as a lot more valuable because you can actually relate to some of the issues. But even there, you have to have done something meaningful. Even if you're a failed founder, you have to have done, I think in most cases, have like solid experience or haven't got to a certain stage. But I will also say that the venture capital, I'm not an expert on this by any means, but the venture capital recruiting process is a lot less formal than a private equity one is. It's a lot more related to networking, who you know, coming up with good, reaching out to people on like LinkedIn's, coffee chats, and doing your homework and coming up with cool ideas as to, oh, I think we should invest in company X or company Y because they're doing this. Hey, I have this pitch for a company that your fund should look into because they're doing X, Y, Z, all that sort of stuff, from what I understand anyway. I interned in private equity, and I thought it would be good for those of you in the room who might be interested in getting a taste of private equity to understand what an internship actually looks like. But in a lot of cases, and this is, I think, another big difference between an investment banking internship and a private equity internship, is the fact that in investment banking, because the investment bank is probably working on multiple deals at the same time, it's probably going to be pretty easy to staff you onto an early stage deal and get you working on the admin or whatever. Whereas in private equity, they are a lot more nitpicky about the deals that they do. So in a given year, you might only be looking at 3, 4, 5 transactions. And so there's no guarantee that when you come and join as an intern in the summer, that a deal is going on, or that a deal is at an early enough stage to be able to put an intern in. Because there's no point putting an intern on a deal that is midway through or in the final stages, because it will take them so long to get to speed with everything that you've covered so far that their internship will kind of be over at that point, right? So as a result, at least my experience when I was at my previous firm was that we would give interns a project to do that would replicate or emulate, I don't know which one's the right word, the sort of work that you might be doing. So it might be something like origination, where you are looking for new opportunities and trying and coming up with an investment thesis. That's actually what I had to do. So the digital infrastructure team were exploring a new subsector, but they didn't have anyone to actually properly research it. They got me to research an industry, identify whether that industry was a good industry to invest in, and if it was a good industry to invest in, to identify a company within that industry, and then run some financial analysis about whether that particular company was worth buying or not. In terms of what you can expect to probably be building, you can normally, so for my project, for example, you will build a PowerPoint pitch deck, basically talking through both the industry and the company. And so you will look at various things. So I'm looking at demand, at supply, about regulation. So you're expected to do it quite comprehensively and to do a lot of research, because the way you're assessed in most cases on an internship is that you will, at the end of your internship, present to the partners or senior leadership team at the firm. And then they will basically just grill you as if you are pitching an investment, and they will ask you a bunch of questions, and you need to be prepared to confidently answer them. So as a result, you need to basically have a pretty streamlined debt because these guys have pretty minimal, they have limited patience. They don't want to go through a bunch of junk. But you also need to have debt, like slides prepared in case of emergency that they ask you a certain question. As I alluded to before, you also have to have a financial model to back all of your claims. So you need to have ideally industry data to support your assumptions around growth. And then you need to say, oh, look, I've put this all into this model. This model is well functioning. I've looked at various different investment cases. I've looked at a good case, a bad case, a medium case, and this is the range of returns that we're getting, all that sort of stuff. Just so that, again, you can speak very confidently and put numbers to words. From my learnings about internships, I'd say that there are three key things that I really want to stress, having done an internship, having assessed interns, and now being removed from the industry. The first is that internships will not and do not accurately portray your life as an analyst as much as they try, as that is kind of the aim of them. And there are a couple of reasons why. Firstly, as I mentioned, just sometimes you are not given the day-to-day tasks that a regular analyst will be doing because it's too difficult to either explain the task or to onboard you and things like that. And sometimes, and a lot of cases, you're not given the really boring admin work to do because, again, it would be too difficult to explain why this admin task actually matters. So in some senses, you're kind of protected and you're given a rosy view of what life as a full-time analyst or an associate might look like at the firm. And in some cases, they might even protect you in terms of your hours. So, and I think this is true of private equity, but also of investment banking, because I think it's Bank of America where interns are capped at 11 p.m. 10 p.m. each night. Whereas if you work full time, you'll be working well past midnight, 1 a.m., 2 a.m. So that's the first thing. But also, and this kind of leads me to point two, your mindset working full time will be different because if you're an intern as a second or even a third year, you kind of just think of it as like an 8 or 10 week sprint. And after your 10, all you've got to do is, you've got to secure the full-time offer and then you're back at university. It doesn't necessarily click in that this is the thing that you're going to be doing for the rest of your life. And so what I would really recommend to people if you're doing an internship is to properly reflect on the work that you're doing and the life that you're living, and probably know that it's going to be more difficult as an analyst or an associate than as an intern. That's not to scare you. It's just, I want people to have a proper, full picture of what their lifestyle might be like and make decisions from a more informed basis, rather than doing 8 to 10 weeks going, oh, that was a 10-week sprint. I think I might have liked it, but I'm going to gloss over all of these negatives, or I haven't been exposed to all of these negatives. So I would really suggest that you go and speak to the full-time analysts and associates and understand what the extra responsibilities that they are doing are, what their life looks like, why they're staying later in the office than you are, so that you get a more complete picture of what you might be doing. And then finally, sometimes things do go out of your control. When I was working, had multiple instances where we liked the intern, but company hiring policies changed. We went into a recession, and so there was just no headcount to take them on. And then sometimes we've done like U-turns where initially we didn't think there was headcount, and then we realized we need headcount. And so what I'm trying to say is don't really hold too much value in whether you convert or not. Sometimes you've done excellently and you are a really good candidate. It's just not in your hands. And so don't get disheartened by that fact if you do not get the result that you were expecting. I think I've gone through all of this. It was part of the life cycle, but when you're originally working on buying a company, you'll focus on origination. So you'll be researching new industries, you'll develop and refine theses, and you'll also try and identify future targets for the fund to acquire. Once you've bought it, it's all about improving the asset, working with the management teams. So I used to fly every month or 2 months to Poland, which was where one of the companies that we owned were. And I would sit in the board meeting, speak to the CEO, CFO, understand the data that was coming out of the company, what was going well, what was going wrong. And then you've also got deals. So as I mentioned, at the start, you will look to buy the company once you've developed the thesis. And then at the end, once you've grown the company, hopefully, and delivered a good return, you will look to sell the company. I've talked about what you'll be doing as a private equity analyst or an associate. This is kind of like what you'll be feeling as a private equity analyst or associate. So the first year, at least at my firm, they were relatively nice. They would give me not too difficult tasks to do. It might be a lot of slide work, a lot of admin work, or not too difficult financial analysis. And so as a result, that will make your confidence shoot up because you think, oh, actually, I'm settling in really, really well. But it's only after that first year where the expectations completely shift and they go, you've been here for a year, you got to grips with the firm and what the day-to-day tasks. Now we're actually going to try push you and give you a lot more difficult work to do. And then that's the point where you realize, oh my God, there's so much additional stuff that I had never considered as part of asset management deals or origination that I've now got to learn. So this was when they were asking me to like build a model from scratch or asking me to run really complex LP/GP performance fee calculations and things like that, where I just was not prepared for, having not worked in investment banking and not really fully developed those technical skills in my first year. And so this will massively hit your, or at least for me, massively hit my confidence and also forced me to really go out of my way to learn those technical skills. So I was getting into the office at 6 a.m. and working on models in my own time until 9 a.m. and then doing my regular day until 9 p.m. and then again doing additional 1 or 2 hours of modeling from 9 to 10 or 9 to 11 and then going back home and sleeping. And I was like that for a period of like 4 to 6 months or something. Because effectively, I was almost forced to replicate investment banking hours and to spend time with models for me to get comfortable with modeling skills. And then eventually, once you've gone through all of that difficulty and despair, you'll come out the other side feeling a lot more confident in your abilities, and you won't be filled with dread every time a director asks you to run a bit of analysis, because your mindset will shift to you thinking, oh, actually, I stand a pretty good job. I stand a pretty good chance of doing a good job at this task. And so you'll feel a lot more confident. And that's probably the point at which you'll both not only get more confident, but you'll also develop skills along the way. And that's the point at which you will probably make associate or get into a year or so of being an associate. So let's go to recruitment insights. Number one thing you can do to boost your chances of getting into investment banking or private equity is this: follow me. So as I mentioned, I've got a bunch of resources. I've covered a few things in this talk, but I have more. I've gone into a lot more detail about certain topics, either on my TikTok or my YouTube. And hopefully I am building out my own website, ASURE.uk, to go to build out things even further. But that plug aside, the way I think about the application process, this is a standard five-step application process that is normally true whether you're applying for investment banking, asset management, sales and trading. Normally, you submit your CV, cover letter, you do a hire view, you do online tests, and then that's at that point where they might invite you for a phone interview and then an assessment center. Mentality-wise, I just tell people to just focus on nailing the fundamentals between steps 1 and 3, because ultimately, I don't know, unless you work in I'm not even sure if recruiters really know what differentiates one CV from another. I think it's just a bit of potluck, or it's a numbers game as to whether you progress through those rounds. So all I would encourage you to do is just focus on getting the bare basics right. So is your CV one page? Are you focusing on your impact? Are you doing a proper amount of research on your cover letters? Have you got stories prepped in advance for your hire views? All those sorts of things. That should be what you're focusing on. And beyond that, don't worry too much. As long as you feel like you've given it your best go at that stage, you should just be content and move on. And hopefully one of your many applications will hit. It's very, very unlikely that you're going to get a success rate above 10 or 20%, let's say, just because no one really knows what the sorting algorithms really look like at the bank. It's once you get to the phone interview and the assessment center where I personally think, okay, it's now actually down to you to go and show off your skill, your preparation, and actually show off your understanding of finance and things. So that's that point where you really want to dig down deep into your technical understanding, your research about the firm, the deals that they've done, what separates them from the rest of the crowd, all that sort of thing. As part of that, I recommend to people that you recap some of the preparation that you've done for steps 1 to 3. Because if you get asked motivation questions like, why this company, or why investment banking, or why private equity, ideally you should have all of those answers already in your cover letter. So you just have to look at that as your source of inspiration when you get asked it in your phone interview. Similarly, a lot of the times at assessment center, they'll still ask you about oh, tell me about a time you worked on a team, or tell me about a time you worked against a tight deadline. You get those questions still asked at a phone interview or an assessment center level. So you should have prepped answers for those at the higher view stage. So do not hesitate to look back at your preparation, document your preparation at each stage, and look back at it when you're doing your phone interview and assessment center prep. And then I've already mentioned what ASURE does. My observation was that a lot of people don't break into their dream careers because of a lack of understanding at the right time. And in a lot of cases, that isn't even at the university stage, but students are making the wrong decisions even whilst they're at school, whether that is the grades, the subjects that they're selecting, whether they don't get work experience or they don't know how to write their personal statement. All of those things can have compounding effects on their employability in the long run. And so I want to create a one-stop shop to provide a full amount of visibility and transparency around careers that the UK education system does not currently provide. And so that is my mission. And you guys can get involved by, as I mentioned earlier, following, sharing the word about ASURE to any friends you might know. Refer parents and young students to our tutoring and uni/career guidance. And if you want to become a tutor, because we also offer academic and also career tutoring, you can apply to join our tutoring team. And how I can help you, as I mentioned, I do lots of free content that you can benefit from. But if you are looking for one-to-one help and coaching and mentoring on breaking into investment banking or private equity, I can, of course, help there as well. Just reach out to any of the emails I've listed here. Any questions? Thank you very much, guys.